Hello, good afternoon. Thank you for joining us at the S&P Global Platts Forum at the 2021 APLA. This is always a wonderful event that I am always very pleased to participate in. APLA, this is one of the premier global petrochemical conferences, and it's always a great privilege to present to you in this setting. And hopefully next year we'll be able to meet together face to face once again. Next slide, please. We've got three very distinguished speakers joining us today that I'm happy to introduce. First will be Guilherme Baida, who's the senior editor covering the Latin American polymers markets, followed by Kristen Hays, who is our global lead for polymers, and followed by Rob Stier, who directs our America's petrochemical analytics group. Guilherme will be talking about the situation in Latin America, providing an overview of the recovery there being driven by global markets. And Kristen will provide an update on the global supply chain and challenges that the polymer markets around the world are facing in a pandemic environment. And then Rob will be providing an overview of North American outlook. I'd also like to take a moment to talk about some of the new assessments that we've been working on here at Platts. We are now publishing, we've expanded our portfolio of America's recycled plastics coverage. We've now got assessments for recycled PET, both pellets and food grade pellets and flakes, as well as now recycled high density polyethylene in North America. We also just recently launched assessments globally in Singapore, London, and Houston for methanol as a bunkering fuel. You can find more information about those new assessments at platts.com. And with that, I'm going to turn it over to Guilherme.
Hi, my name is Guilherme Baida. I'm the senior editor responsible for the coverage of the petrochemical markets in Latin America, and I'll briefly cover the main topics in the region for the coming months. Actually, I don't see the slides though. Is it showing? Yeah, all right. First, I'll go through the major global trends in Latin America so far in 2021, as the US is starting to regain its market share of polyethylene, especially to Latin America, after months losing room to Asia. I'll talk slightly regarding polypropylene and how it continues to be under the influence of Middle East and Asia, and how locally Argentina and Colombia are the greatest players for both homopolymer and copolymer. I'll talk about freight and how it has impacted largely the region, with logistics costs surpassing the 500 levels per metric ton in the past months from Asia to Latin America. Secondly, what to expect for early 2022. Well, I'd say more availability from the US, which may soft prices for the coming months, and also considering the inventory tax which the US Gulf Coast has in the turnover of each year, that may put some pressure on whoever has a big inventory level, and that can address some discounts in the market. Asia definitely has more competitive FOB prices. However, if you consider logistics costs, impacts largely their CFR numbers. We'll see that. We also saw that how Asian prices were increasing in the past weeks, while US prices also gave room. So that made US prices more competitive again. But we saw that during this year, Asian prices were actually pretty much lower than US prices in CFR levels, FOB levels actually, like $200 to $300 difference, mostly because the US did not have availability to export. And thirdly, we'll have a view on how much COVID-19 had impacted the region this year, like it did last year, where markets are actually recovering. The automotive industry, one of the main demanders of polypropylene, still pretty much down in terms of production. However, demand is surging back. Polyethylene is back again, and we expect it to be even better for next year. While PVC saw some record high prices in the past months, now softening with more availability. And we'll also talk about currency depreciation and how it affected the Latin American markets. Next one. Okay. This one, in this slide, we can see a graphic from Platts Analytics that shows the global net trade for polyethylene and its projections for 5 years and 10 years from now. This is for us to understand how the US market is very, very much important in terms of supply to the Latin region, where you can see the gray lines in the left, big gray lines in the left. However, during the course of this year, the Latin American countries had to find a way of sourcing materials elsewhere, as the US had a very limited availability in the first and second quarters of the year. I'll say if not availability at all to export. That's when Asia actually became really important for the region and turned it to be, the most competitive region CFR levels for most of the materials up to the third quarter, when rising freight rate impact the final values, bring the US back on the game again. Next slide, please. In this one, we can see that this is a set of graphics, and we'll see how the Latin directions of polyethylene are usually driven by the US, which is represented by blue line in all graphics. Starting with high density glow molding, we can see that the orange and green lines, which represents Brazil and the West Coast, follow mostly the blue line movement you can see here. The yellow line, which is Asia, can sometimes be seen even higher when compared to Latin America, when compared to the US. That's when COVID-19 started and changed shifts of what we usually see in the market. We can see several market changing events in the graphic. The reflex of Hurricane Laura and Delta, which drove US prices pretty much up, sorry. And then we can see the deep freeze impacts in Texas and Louisiana, which made prices reach its record high levels in major international markets, and of course in Brazil and the West Coast. And we can see that the Asian market currently has the lowest FOB levels in the yellow. However, it lost a lot of competitiveness in the way. As you can see, premiums softening in the graphic, at least since mid-year. If you add freight costs, which is around $560 from China to the West Coast and around $500 to Brazil, its polyethylene prices become higher than US values nowadays. Next slide. Okay. This is for low density polyethylene, but it's really similar. You can see the same trends here. Brazil and the green lines are correlated to the blue line movement, which is the US. We can see some shifts in prices from US and Asia, but now we can see that the US is actually the cheapest market worldwide. Since the last decreases in October and higher prices in Asia. But you can also see a very, very large premium between Asia and the US during mid-year. However, now the US has the most competitive prices. Why, however, people would still buy from the US when this premium was pretty much up? Well, security of material quality and delivery time. There were times when transit time from Asia would be around 45 days, which is, the lowest time we can expect from China. However, in the third quarter, we can see like sources telling us material were taking up to 4 months to arrive in Latin America. So US material, even being the most expensive at that time, had its advantage for the ones that had actually good inventory to wait. Next slide. Here for linear low density polyethylene, we can see some shifts during the pandemic, and Asia is spotting prices in yellow line even higher than Latin America at the beginning of COVID. Now, considering freight rates surpassing the 500 metric ton mark and US prices softening, the US becomes again the cheapest option for that material. Note that again, the delivery period is also at least half time compared to Asian. So if not less than that. So US material becomes really much attractive at the time. The US is historically the most competitive because naturally production costs of polyethylene in the US are lower than Asia under normal conditions. What does that tell us? Well, that the US continues to be the benchmark in the region for polyethylene, resuming its market share now. Next slide. Here we'll cover briefly the directions of imports and exports from Brazil of high density, low density, and linear low density polyethylene. We'll begin with high density polyethylene, and in the left side are imports, and we can see it did not increase largely in terms of volume, considering January to September, just a 13% increase. However, if you see the FOB values, it did increase a lot, 92%, which tells us pricing average was much higher in 2021 than it was in 2020. Other point are the major exporters to Brazil. No big change in the top three. You can see the US, Argentina, and Saudi Arabia. However, China made room this year and it was not accounted last year. So we can see Asian markets going into Latin America with more presence this year. On the right side, exports fell 32% in volume, showing a higher consumption in the domestic market. Destinations were mostly the same. Next slide. We see here the same table for low density, where imports were up actually 43% in terms of volume, and FOB values were up actually 124%. So you can see the difference here. Saudi Arabia was the #1 supplying country in 2021, but not actually last year, while the US and Argentina represented actually around 70% of the market this year and around 80% of the market last year. On the right, you can see that exports fell 24% in volume, but increased at 41% in value. So showing again, average prices were higher on the year. Netherlands appear as top 1 destination, followed by South American countries. Next slide. Here, finally for linear low density polyethylene, the same trend. Volume up 30% and values up more than 100%, while the US grew its market share to 65% and Argentina lost its market share during the period. In terms of exports, a fall of 30% in volume, but a hike in 32% in FOB prices. Destinations were mostly the same. Next slide. Here we can see just the same graphic I show you for polyethylene, but for polypropylene. You can see that this doesn't account much for the trade flow, as Asia and the Middle East are very important in terms of exports to the Latin region, but shows us the net trade of Latin America in general. We can see the high offer of the Middle East compared to the other regions, which makes them the most competitive for polypropylene. Locally, we can see here that Argentina is very, very competitive for polymer, and Colombia with copolymer. Next slide. I'll talk briefly here regarding the importance of each region. Middle East and Asia are the most competitive players and have the most competitive prices globally. It's most often the cheapest option. However, depending on freight rates and handling costs nowadays, it can be sometimes more expensive than local offers. Argentina is very competitive for homopolymer in the region, being the largest exporter. We'll see the numbers to Brazil and the whole region. Actually, it's not always the cheapest option, but it does not face any importing or exporting duties. So that makes a lot of difference. Colombia, on the other hand, is very, very competitive for copolymer products, and it exports a lot towards the region, same as Chile for homopolymer. Brazil has the production of Braskem. Domestically, it holds around 60 to 70% of market share, but it's not as competitive as the other main players in terms of exports. It does export a lot to Mercosur, but not so much overseas, though. Not so much competitive overseas. The US, we can see it's not competitive in terms of polypropylene, at least not lately, where prices were the highest globally due to tightness of availability and production. We can see below in both graphics, we see the same trend as we saw in polyethylene. Too much rise from the US after the impacts of the deep freeze in February, with Latin America mostly following Asia in the down lines. Next slide. Here we see again Brazilian imports of homopolymer in the left, with an increase of around 60% in volume and around 120 in value. We also see that Saudi Arabia became #1 exported, and Colombia lost a lot of market share. In the exports, we see Brazil decreasing its exports by 47%, and mostly focusing in South American countries. It even exports some to the US due to tightness in that market. Next slide. Copolymer. So the same trend for copolymer, an increase of 29% in volume and 60% in value from January to September. Saudi again made to #1 exported to Brazil. And we can see a big presence of Asian countries at the top export leaders. In terms of exports, Brazil's volumes fell around 20%, while prices grew 33%. That shows us again how much prices average actually increased during the period. Next slide. Changing now to PVC, I'll say Kristen always tells this, the golden boy of the moment. In normal times, without the effect of the pandemic or hurricanes or deep freeze, PVC usually very stable. However, after the start of COVID, the reflections of Hurricane Laura and Delta, the deep freezes, we can see that US prices were actually very, very much expensive during last year, even more than Asia. And that changed the commercial flow of this market. You can see that last year, prices of Brazil and orange and the West Coast in green are the highest. This all-time high record prices were seen all across the globe during last year and this year, reflecting this in the West Coast and in Brazil. In less than 2 years, we saw all-time record lows to all-time record highs to show how great the volatility of this market was during the pandemic. Next slide. Just to give a better picture of imports again, in Brazil, we saw that imports actually grew around 130% in volume and almost 300 in value from January to September. China in the top 2 suppliers list, while the US does not appear because it had no competitive prices and it faces import duties in Brazil. Taiwan, you can see almost triple its volume exported also. In terms of exports, it fell largely around 80% as domestic producers mostly focus on local markets. Next slide. Here's just to have a better picture of domestic markets. This is just domestic markets and how its prices also increased. In the left, you can see prices based in US dollars per metric ton, so they're increased. And in the right, you can see those prices in their local currency. And you can see how much those currencies devaluations impact. The yellow line is Argentina, and you can see how much it impacts in their local currencies. Next slide. So how has Latin polymers trade flow were affected by Forex? Mostly because some importing countries have seen their currency depreciated strongly against the US dollar since the start of COVID. We can see that the most affected was Argentina, Brazil, followed by Peru. Chile, Mexico, and Colombia had also depreciations. How does that affect the market? It affects because it reduces the purchase power of each currency, therefore making the domestic product sold in each particular currency more attractive, actually. That was my view on the Latin American markets. I'll pass now to Kristen Hays. Thank you.
Well, hello, everyone. Thank you again for inviting us to speak to you at APLA. I'm Kristen Hays, the Global Market Lead for Polymers here at S&P Global Platts. I think we can all agree that it has been a very interesting 18 months for polymers globally, to say the least, with lots of volatility when COVID hit last year and then pricing run-ups to record highs since mid-2020, when consumer demand pretty much exploded for everything. So let's get started. Next slide, please. Here is my agenda. We're going to talk about how US PE supply has recovered, but polypropylene and polyvinyl chloride supply remain pretty tight as we go into the year end and early 2022. We'll also take a look at new supply coming online in 2022 for all 3 of these polymers, but only PE is seen returning to an oversupply situation that we saw in early 2020 before COVID hit. Next slide, please. So let's start with 2020. COVID shutdowns, first in Asia, then in the US, Europe, the Middle East, and Latin America, reduced resin demand for a while. PE demand weathered that dip better than resins used to make more durable plastics like PP and PVC. By mid-2020, however, shutdowns had eased and consumer demand spiked for homes and cars, finished products made everywhere in the world that are delivered by a container to the US. 2 hurricanes hit Louisiana in August and October last year and squeezed olefin and polymer output a bit. But the really severe impact came, as Guilherme mentioned, from the deep freeze that hit the US Gulf Coast and much of the inland US in mid-February this year. That forced widespread shutdowns for weeks. After operations came back online, US PE producers reduced exports to meet strong domestic demand and restock thin inventories as the US entered the 2021 Atlantic hurricane season. PP and PVC exports also declined, but the pull of strong domestic demand has hindered restocking efforts, so inventories for those products remain lower than they would like. This is particularly true for PVC, which got hit badly by Hurricane Ida in August this year, which I'll address in a bit. Next slide, please. Here is a look at the impact of the freeze. You can see here that huge swaths of ethylene, polymer grade propylene, and resin production came offline, some for a month or more. Nothing in the U.S. Gulf Coast region is built to withstand sustained below freezing temperatures that held for more than 72 hours. Restarts were very slow as producers had to stop as they went along to fix cracks, pinhole leaks, and other problems. And it took months for producers to really dig out from this impact, with demand remaining strong all the while. This is largely why we see PP and PVC stocks remaining fairly low. They had been selling hand to mouth. There is a lot more overall PE capacity in the US, of course, than PP and PVC. So when they pulled back on exports, they were able to sufficiently restock. Next slide, please. Okay, this map gives you an idea of the scope of the freeze fallout. When a hurricane hits, it generally impacts a fairly concentrated area. Hurricanes Laura and Delta in 2020 hit Lake Charles here on the right and had minimal impact on Texas operations and none on the concentration of petrochemical plants further east in Louisiana alongside the Mississippi River. But all of these petrochemical centers shut when the freeze hit and temperatures plunged on Valentine's Day. Unlike having days to plan for a hurricane's landfall, the freeze descended without really detailed forecasts, and many plants underwent so-called hard shutdowns, the kind that happen fast when power goes out that no producer wants to experience. Next slide, please. By contrast, here's the region most affected by Hurricane Ida's landfall in Louisiana on August 29th this year. Like Hurricane Laura last year, Ida was a Category 4 storm when it hit land, packing 150-mile-per-hour winds, and it maintained hurricane strength until the next morning when it turned toward Mississippi. This region was spared the effects of Hurricanes Laura and Delta in 2020 and the freeze, but Ida showed little mercy. However, this region is much more PVC-centric. The freeze took nearly 75% of US PE production offline, while Ida forced shutdowns of a little more than 20%. That did not undercut all that work to restock over the summer. Ida's impact on PP was less. Only 2 PP plants were affected, or about 16% of US capacity, compared to at least 62% that were shut with the freeze. But PVC, Ida forced shutdowns of 4 PVC complexes plus upstream standalone chlor-alkali and ethylene dichloride plants. Overall, Ida took about 41% of North American PVC capacity offline. While that is less than the 57% that shut for the freeze, Shintech had to shut its 1.45 million metric ton per year PVC unit in Texas. That's the biggest one in the US. Days after Ida's landfall, because Olin's upstream vinyl chloride monomer plant in Freeport shut unexpectedly on an equipment failure. Together, that was 59% of North American PVC production offline at the same time. So 2 major hits to PVC in the same year, while PE and PP escaped Ida's wrath for the most part with fewer bruises. Hurricane season does not officially end until November 30th, but it's safe to say that producers, buyers, and traders are now breathing easier as we enter the winter months. Next slide, please. Okay, so let's take a look at pricing. You can see here that Asian HDPE blow molding prices diverged from those in other regions in early 2021. Several things prompted this move. First, the container squeeze that emerged in 2020, which grew worse in Asia, and record high freight rates on containerized Asian exports pretty much forced Asian PE prices to hold at lower levels than those in other regions. At the same time, the freeze in the US crushed PE availability of that and a myriad of other petrochemicals and resins, sending prices to record highs. And in Europe, a string of operational issues and a dearth of imports from the US after the freeze also sharply tightened that region's PE availability. In Latin America, countries along the west coast of South America, as well as Brazil, saw availability of US and European materials shrink dramatically, driving prices up in those regions as well. Next slide, please. Here's a look at US PE exports. for the last 3 years. You can see clearly how they declined since March this year as producers work to restock. They pretty much got things back to a fairly normal levels, but not quite back to pre-freeze levels in January, as you can see. So there is still a little more restocking to be done before the end of the year. Next slide, please. You already saw this map with Guilherme, but there's a quick look at how Platts Analytics sees global PE trade flows over the next decade. The top 10 export destinations to date this year for US PE are Mexico, China, Canada, Brazil, Belgium, Colombia, Chile, Malaysia, Peru, and Spain. You can see here that North America and the Middle East are clearly the supply centers. They will compete to supply Asia, the top demand center, and Central and South America remain key markets for US outflows, particularly given that proximity. Next slide, please. On polypropylene, you can see here that US export PE prices wildly diverged from those in other regions, starting with the smaller increase after the 2020 hurricanes hit Lake Charles in Louisiana. You can see prices began retreating as producers recovered from the freeze, yet spiked again starting in June. That second spike, exacerbated a bit by Hurricane Ida, but that little tiny bit, is largely on tight supply. These price levels have largely been seen as notional because producers were not really even offering much spot export volumes given the strength of US domestic PP demand. Market participants say there just isn't enough capacity to meet overall demand, so exports pretty much dried up on a spot basis. Even the startup of Braskem's new 450,000 metric ton a year PP unit in Texas hasn't given much of a dent given the increase in demand after COVID shutdowns eased. Next slide, please. And here's a look at PP exports. You can see the crash in demand reflected in April and May 2020 outflows. That's when vehicle manufacturing plants ceased operations at the height of COVID shutdowns. You can see 2020 outflows increased over the summer last year as those manufacturing plants came back online. And the blue lines show lower outflows most months this year, reflecting how spot export volume availability just dried up amid domestic and export contract demand. This demand has been strong even with the global semiconductor shortage, which has again prompted vehicle manufacturing plants to cut back or shut down. If there was not a chip shortage, availability would likely be a whole lot worse. Next slide, please. And on PVC, you can see the crash and rebound in 2020 and where prices in China and Southeast Asia diverged from those from other regions going into the end of last year. By that time, supply was recovering from the Louisiana hurricanes and Formosa Plastic USA's operational issues at its Texas complex. And market participants expected pricing to ease in early 2022 and early 2021. Then the freeze hit and prices in all regions jumped again. The COVID spread in India suppressed demand there until about August, just in time for Ida to take 41% of North American PVC production offline. At the same time, Europe saw a slew of operational issues in late 2020 and throughout this year that siphoned their supply availability. And again then came Europe's high energy costs, which have prompted some producers to impose surcharges, not just for PVC, but on other polymers as well. Record high freight rates kept Asian prices under those in other regions here, as you can see. This uptick in Asian pricing was an initial response to supply concerns after the Chinese government imposed energy consumption rules that forced rate cuts and some plant shutdowns, particularly for carbide-based PVC. That made Asian volumes even more uncompetitive in other regions. For Latin America, this has been particularly difficult. West Coast South American buyers either have to pay record high US prices or eat those freight costs for Asian imports that may or may not arrive as planned. And Europe has had little export availability given its issues, and what could be shipped out comes at high prices as well. Next slide, please. Okay, here you can see the decline in US PVC exports as producers sought to feed strong domestic demand with lower overall volume availability. Exports are expected to inch up through the rest of the year if demand in the domestic market declines seasonally, as is typical for PVC in the winter months. We have seen export PE and PP prices retreating in recent weeks. For PE, that signals a return to the oversupply situation I mentioned earlier, and Rob will get into that here later. For PP, it's about prices really kind of coming back to reality from their notional levels. U.S. export PVC prices remain at yet a new all-time high, but market participants expect a gradual retreat as well as producers hit by Ida continue their recovery and Shintech's long-awaited expansion comes online. And of course, all of this could change in an instant if the U.S. gets another freak weather event like we did in February. So that possibility is hanging in everyone's mind as well. Next slide, please. And speaking of expansions, here's a look at what's coming up late this year and in 2022 for U.S. polymers. The Exxon Sabic joint venture in Texas and Shell's new complex in Pennsylvania will bring another 3 million metric tons a year of PE online, pushing North American capacity up by about 12%. That's a big reason why the U.S. is looking at returning to an oversupply situation in 2022. For polypropylene, Interpipeline and Exxon each have projects slated to come online in 2022, which will push North American supply up by about 10.5%. But market participants expect demand to remain strong, and it will be a long time before Exxon's new capacity starts up, maybe a little less than a year from now. And for PVC, the capacity increase is less than 3% for Shintech's expansion startup in Louisiana. This is the first phase. And Shintech's second phase will add another 380,000 metric tons a year, or 4.4% in 2023. But market participants say that's still not enough to meet the expected demand growth. So far as U.S. housing is concerned, costs that have gone up $20,000 to $30,000 per home during this U.S. housing construction boom has not dampened PVC demand, which has supported those record high prices. But many market participants expect prices to retreat, but maintain historical highs until we see U.S. mortgage interest rates actually start to rise. And with that, that's all from me today, and I'll hand it over to Rob.
Kristen, you can switch to the next slide. Okay. Next. So we've had a lot of talk about what's happening with energy and surcharges. One of the drivers of higher prices over the past few months has been the unprecedented increase in natural gas prices in Europe and Asia. We hit, I think, a high print on our JKM LNG benchmark price of close to $50 an MMBTU in October, as the issues around the world getting enough natural gas to run their power plants really was exacerbated by gas flows into Europe from Russia, a coal shortage in China. There's a lot of connectivity now, all the way from oil, nat gas, and coal, all the way through the entire value chain. It's dragging up feedstock prices. Propane is at a significant discount to LNG prices in both Asia and Europe. So anybody that can burn propane in place of natural gas should be doing so. And that's going to take place mainly at the refineries in Europe and Asia, where they can do that. But basically, we're seeing prices for natural gas reach demand destruction levels so that the regions can build inventory in anticipation of heating demand during the winter. And it's already cold in China. I think they've had snow in Beijing, which is a couple of weeks early. So they're really scrambling to get that energy security of supply in place before the winter. And hopefully we don't have any major polar vortexes hitting the high population areas, and prices don't continue to scream higher, because the only price ceiling is really demand destruction and having people turn away from buying and selling their product back into the marketplace. Okay, next. So we talked about the connectivity. I used the Legos, which have been in the news a lot recently because everyone's worried about getting their Christmas toys in time to put them under the tree or any other holidays that people celebrate this time of year. We're seeing major supply disruptions. But if you look at Lego and how do you get from a tight LNG market in Europe where natural gas prices hit $30, $35 an MMBTU, compared to $5 in the United States. So prices hit 6 or 7 times higher in Europe for natural gas today than they are in the US. And that resulted in a number of actions taken by market participants, including shutting down ammonia plants. Ammonia is made with natural gas, and the price skyrocketed, and ammonia prices couldn't keep up, so they literally shut down the plant. Lots of unintended consequences associated with that. One of them is that ammonia plants generate a lot of byproduct carbon dioxide, food grade carbon dioxide. So all of a sudden, bottling plants for soda and beverages had to shut down, and the UK government actually gave economic incentives to the ammonia plant to start back up, so they wouldn't shut down a whole bunch of downstream plants that rely on their co-products. But the higher nitrogen price impacted acrylonitrile, which uses ammonia as a raw material. That impacted the ABS plastics prices. Legos are made of ABS plastics. That's why they're so durable and last decades. But then you have, if they're not made in the right place, how do you get the Lego sets delivered to the retail stores when you have all sorts of trucking issues, shipping container issues? That leads to higher prices. Kristen mentioned the surcharges. You get inflation, and then now potentially shortages. So that's happening all over the value chain. Started with coal and natural gas and worked its way through the entire value chain. And this Lego ABS building block is just one example. Next. I've been in the marketplace for longer than I care to admit. Started as an engineer at one of Lyondell's plants back in 1985. I've seen lots of periods where we've had events. You think back to Y2K, the Enron implosion, the financial crisis of 2008, but I have never lived through the type of events that we've seen over the past 2 years. I've personally been involved in 800-year floods, a couple of Cat 5 hurricanes, the freeze that Kristen mentioned that, I was sitting here in Houston on February 14th and the power just went off. I had no idea we were in for a 5-day deep freeze, and apparently nobody else did either, because there was a number of hard shutdowns. And I would expect that there's still a few lingering problems that producers are trying to correct all the way back from February, where equipment really got broken and it's hard to replace certain pieces of equipment in this supply chain disruption world that we live in. But if you look, the bifurcation of what happened in the Atlantic Basin, Europe and the Americas, we were like living on a different planet over the summer relative to what was going on in Asia. And the real driver for that was outages, shipping container logistics problems, lots of new capacity coming online in China, which kept margins at a low level. We talked about the chlorovinyls price chain skyrocketing. Caustic soda prices have skyrocketed over the past 2 months because of the high natural gas. Natural gas is a key raw material to make chlorovinyls via the cogen power generation, right? Chlorovinyls are electricity and salt. If electricity prices go up 5-fold, you need to raise your chlorine and caustic soda prices to cover that dramatic increase in raw material cost, and that's what's happening now. We're seeing ECU values, go up $200 at a clip here to keep up with the high natural gas price. So we have all of these kind of black swan events. Kristen characterized it as the perfect storm. It has been unprecedented. And we do not forecast another year of unprecedented events in 2020, which lead us to believe that once these events are over, we make it through the winter, we don't have any prolonged polar vortexes in high population areas. The forward curve or the futures market for natural gas is already predicting or pricing in $10 for LNG next summer, relative to the $30, $35 prices that we saw during October. Okay, next. Outages. The number one driver of what we have experienced in the global petrochemical market in the Atlantic Basin, the Americas, and Europe over the past 2 years can be summed up in one word: outages. It started with the unprecedented demand destruction that we saw in Q2 2020, where everyone shut down. Never seen anything like that in my career, where companies actually announced economic shutdowns. Dow came out and announced a number of global plant closures back in March of 2020. I've never seen that before. Companies typically don't announce they're shutting down plants because they're not making money, but this whole past 2 years has been unprecedented. Use any characterization, description you want, but the outages have really driven the tightness in the market, and demand is also rebounding from the first half 2020 lows. So we have a period of very strong demand coming out of COVID, all the lockdowns, combined with record high outages, and that leads to the record high prices that we just described over the past 40 minutes. Next. So if you look at the global ethylene supply stack, here's a snapshot at the end of October. Basically, we're moving into a market where global ethane is one of the most advantaged low-cost feedstocks. And as we talk about the energy transition and the role that hydrogen could play in that energy transition, ethane crackers generate a lot of hydrogen, which long-term could be a very valuable co-product that typically hasn't gotten much attention. But if you think about it, you're taking ethane and you're removing two hydrogen molecules or hydrogen to make ethylene. So it's one of the perfect feedstocks for the energy transition if hydrogen is going to take a big role. The other advantage feedstock today is naphtha, and we do expect naphtha to be an advantage feedstock long-term as well, and that plays into the whole oil to chemicals story, where if you look at what's going on specifically in China, they're really integrating refineries with flexible or multiple feed ethylene crackers so that they can go from oil to chemicals and minimize the transportation fuel production as we transition into electric vehicles. Okay, next. I'm gonna have to really accelerate here, given we have about 10 minutes left. So I'm gonna skip this chain, this graph, but if you keep going through the next animation. So next, there should be two animations on this slide. Let's get to okay, one more. And there you go. So again, the highlight of this, we've already gone over it earlier this morning, is outages, supply chain disruptions, container freight issues, the perfect storm that we believe will be resolved over the next 3 to 6 months, especially as we get past winter. And April of 2022 is going to look a lot different than November 2021. Okay, next. If you look at the price parities, and what I want to highlight here is the difference between Asia in the middle and what's going on with the ethylene value chain in the US and Europe, EU, European Union. So this is the spot ethylene is in red, and you can see in the US on the left bar chart where spot ethylene is about $800 a ton, and at that price, you can profitably make MEG, ethylene glycol, high density, styrene monomer, PVC. They're all profitable if you assume your ethylene cost is at market or $800 a ton. And you're also making money with all the feedstocks. So the US is kind of in that sweet spot, Goldilocks, just right market condition. If you look at Asia, spot ethylene is just over $1,000 a ton, but high density polyethylene, basically you're not profitable using $1,100 a ton ethylene to make $1,100 a ton ethylene, high density polyethylene. So that there you see no margin. Ethylene glycol is even worse. You're not making any money making ethylene glycol and selling it in Asia if you're basing that selling price off of $1,100 spot ethylene. And styrene monomer and PVC can afford ethylene at that price. So you would say in Asia, the reason why ethylene's trading at $1,100 a ton is because somebody in the styrene or PVC chain are buying that spot ethylene. It is not a polyethylene or an ethylene glycol buyer. And then finally, in Europe, you see kind of like we saw in the US, it's priced just right. All the feedstocks are profitable and all the derivatives are profitable. So that's a very sustainable condition as we speak in today's environment. Next. We talked about margins. We already saw US spot ethylene margins go negative, especially for propane, when propane reached $1.50 a gallon earlier in October. It really crushed ethylene margins. So we saw minimal cracking or feedstock demand for propane during that period. And you can see it only stayed negative for about a month. Typically, you do see a supply response and a demand response on pricing. You don't have negative margins forever. Something which is not sustainable won't last, the old cliche. And we're going to say the opposite. When we see prices go to demand destruction levels at record highs, that also, like these zero margins or negative margins, is unsustainable. Next. Now we'll take a look at, this is a 5-year graph. If you're familiar with refinery seasonal graphs, this is the same thing. So the gray area is the range of these margins and spreads over the past 5 years. And then you've got the average in black, last year in blue, and what year to date in red. So you've seen ethane cracking margins peaked right after the freeze at 50 cents a pound, and they've sold off to as low as 20 cents a pound recently. And they're rebounding a little bit here because we're coming off of the propane margins, which were negative in October. And we got the price of ethylene a little bit higher and the price of propane a little bit lower, and we're back to positive margin. Okay, next. We talked about the building of inventory of polyethylene. So this is from the producer US inventory level. You can see we have rebounded from the February freeze, and in fact, we've rebounded to multi-year highs. So as a fundamental supply-demand analyst, it's hard to describe, here we are with record high inventories. The US is a net exporter, yet we have the highest high density price in the world. How does that work? Well, some of this inventory may not be on spec. There may be a high percentage of wide spec material included in this inventory that would not affect Platts benchmark prices. So we do believe that heading into the end of the year and into 2022, there will be pressure on US polyethylene prices just from a fundamental basis, because it's difficult to justify having the highest prices in a long market where you need to export to be balanced and you've got building inventories. That would lead to pricing pressure, and you need to open up the export arb again. And that is our forecast. It's just going to take some time to work through these short-term supply disruption issues. Okay, next. When we talk about the shipping freight issues, it started off with empty containers in the wrong place. Last year, it spread to the Ever Given and blocking the Suez Canal for 7 to 10 days. But now it's everything. It's port congestion. It's lack of truck drivers, lack of truck equipment, the chassis that you put the container on. Nobody wants to return an empty container. They want to use their truck driving fleet to move goods to the store's shelves, not return empties. So this is a problem. Guilherme mentioned it was like $500 a ton, $600 a ton incremental container shipping freight rate, which is, just unbelievable when you think about sometimes we have delivered prices at $600 a ton. Now freight is $600 a ton on its own. This will get resolved. The economic incentives are there for all of the shipping companies to fix these problems. Most of the shipping companies, they released their Q3 earnings and they were just record, 3 times higher than their previous record earnings. So typically when you have that economic incentive to fix a problem, it will get fixed. And we're assuming it gets fixed by in the next 6 months. Next. So if here's the container index, an increase of 7-fold for the Platts container index. Since the 5-year average is closer to $1,000, and here we are above 7,000. Incredible. But we do believe that we'll start to go lower, and these prices will come down into the spring of next year. Okay, next. Okay, we can skip this one. Just more freight information showing it's pretty pervasive across the shipping routes. You can jump to the next slide. All right, so we're already seeing pressure on margins. Everything seemed to peak in the March-April timeframe once the industry wrestled with the freeze, how long it would take to recover from the freeze. I've never in my experience in the petrochemical industry have seen 70% of capacity down. That is just incredible. And at the same time, you had a bunch of outages that were delayed from Q2 2020 because of social distancing and the economy shutdown. We knew some of those planned outages from 2020 were going to be delayed into 2021, but then you layer an unprecedented freeze and the amount of outages on top of that, and that's why prices in Europe and the Americas have skyrocketed to demand destruction levels over the summer, and we definitely believe these are not sustainable conditions. Next. Same look. High densities really hanging in there, and you have to wonder why. We're a big exporter of high density, and it could be because a lot of the inventory is off spec or wide spec, does not meet the very tight prime blow molding, injection molding, or film grade specifications. So some of this material may be sold as off spec, which is not part of our benchmark reporting of price assessments and discovery. Okay, next. Same thing here. So we'll get into a little bit of where we see things developing over the next 12 months. You've got linear low versus ethane spread at seasonal 5-year highs, approaching 70 cents a pound back after the freeze, which again was windfall profits. If you were running a linear low polyethylene plant in April, May, June during the second quarter of this year, you made record windfall profits. Unfortunately, almost everybody had some capacity down, so you couldn't capture all that margin, which is why it priced to demand destruction, because every single producer had the incentive and still has the incentive to run at 100% of capacity at these margins. Next. We talked a little bit about caustic soda. Again, very exposed and correlated to natural gas prices. Natural gas runs most of the power generation at these facilities through a process called cogeneration. You take natural gas and you make both electricity and steam that you need to run these processes. And so as soon as LNG prices took off internationally, you started to see the increase in EDC, in the vinyls chain, and caustic soda, because you're not going to make caustic soda and sell it at $300 or $400 a ton when your cost in Europe and Asia based on LNG is approaching $800 or $900 a ton. Okay, next. Meg margins have really just been at the average. Meg is oversupplied. Kristen mentioned Exxon's bringing on some additional ethylene glycol or Meg capacity as we speak. Most of that's going to go into the polyester value chain and the big demand growth in Asia for the whole PET bottles and polyester fibers for clothing and textiles. Okay, next. Going to try to wrap it up here with where we see margins heading by the end of 2022. So again, just the volatility in styrene and polystyrene. You've got, these markets are driven by outages more than almost anything. In general, they're, balanced, but a plant or two goes down and you see the price spike. If you look at that price spike in styrene right around the freeze, went from 5-cent margins to 40-cent margins back to 0 in 5 months. That's the type of volatility we can expect in the styrene, polystyrene, or mainly in the styrene chain, to a lesser extent polystyrene. Okay, get to the last few slides here. Next. So propylene, again, propylene in the United States, because we lost PDH capacity, went to demand destruction levels. We saw $1 per pound or $2,200 a ton propylene monomer prices over the summer. Basically, that was just saying I don't have product. I really have nothing to sell. So the price went to demand destruction levels. Asia, much different story. Margins have been under pressure all summer. They've had the power outages, the power allocation disruptions starting in September. They can't export anything because of the container problems. So all your white goods, appliances, Christmas trees, containers full of washer, dryers, and other materials are stuck at the port. So that whole region in Asia has been constrained by production outages, power limitations, shipping constraints, and their margins never really participated over the summer like they did in Europe and Asia. Europe and the Americas. Okay, next. We already talked about, polypropylene and how high the prices went. But look at PDH margins. They peaked in August during the outages. We only have 3 PDH units in the United States, so one goes down for a couple of weeks, and you're going to get a price spike because of the product shortage and tightness. Well, over the past few months, we've seen PDH margins really take a hit, both because of higher propane feedstock prices and because the propylene price came off the demand destruction levels and went from $1 a pound back into the 65, 70 cent per pound level, which is still very high. Okay, next. We talked about the polyester and PET bottle value chain. It's getting lots of support from record high cotton prices. Cotton prices are at the highest level in 10 years, like $1.40 a pound. They're usually 50 cents a pound. And also aluminum prices hit record highs earlier this year, I think 10-year highs. And you can think that 2-liter soda bottles are going to compete with aluminum. So you have a lot of support for polyester, both PET bottles and polyester fiber, from commodity prices. Okay, next. So here's our outlook. Here's a snapshot, and these are the same price benchmark polymer prices that Platts assesses and reports on a daily, weekly, monthly basis. For high density polyethylene, we see all prices staying in a tight correlation because of the arbitrage and export connectivity. And we see those prices for high density polyethylene getting back into the 50 to 55 cent per pound range, which is the equivalent to $1,100 or $1,200 a ton. Same for low density. Actually, low density is probably the weakest of the 3 grades right now, which is surprising. Low density is the highest cost of production because you have to use different technology, high pressure reactors. We see that price maintaining its premium to the other 2 grades of polyethylene, about $100 a ton by premium by the end of next year, and selling off to the $1,200, $1,300 a ton range. Okay, next. Low density, going to be oversupplied, need to export it. We'll sell at a slight discount to high density, which is typical. So we see that price right around 50 cents. And this, again, is by the end of next year. So by Q4 of 2022, this is where we see prices getting to. How they get there over the next 6 months will be very volatile. But starting, Q2 and into Q3 next year, we do expect some pretty steady price declines. And polypropylene, the US will reconnect to the international markets, still maintain a pretty high price relative to polyethylene. And we've been saying that for, I think, the past 3 years at this conference. we've always said polypropylene is going to sell at a premium to polyethylene just based on industry structure, and we expect that to continue. I think one more slide. So next. And then PVC, crazy market. Housing, if you look at what's going on in China with all of their construction companies, they're having a 2008 financial crisis moment in China. I have no idea how that's going to play out. Fed has just announced they're going to start tapering and reduce quantitative easing, impact on interest rates and then mortgages. But regardless, we expect PVC prices to come back down to very high, historically high levels of 50 to 55 cents, which if you go back in time, $1,100 to $1,200 a ton PVC is really expensive. Just doesn't feel that way in today's world when it's close to $2,000 a ton. And then polystyrene, we expect to settle back into that $1,200 a ton range as well. And I think that was my last slide. So if you go to the next one, we should be able to wrap up. Yes.
All right, thanks, Rob. And Kristen and Guilherme, thanks for all your presentations. That was very informative. We do have a couple of questions, both for Rob. So question one, Rob. In the early part of the decade, we saw high volatility in propylene prices around the spring turnarounds. With the high affordability you just showed for propylene, do you expect propylene and polypropylene prices to increase by a lot during the spring refinery and cracker turnaround season?
I don't, because I think by then you'll see propane prices, assuming we do not have polar vortex, very cold outbreaks during the winter, propane should be substantially lower in price than we see today, which will help the economics of these propane dehydro units, especially in China, where they've been under pressure. Propane dehydro margins in Asia went to zero during October. And assuming just a normal level of outages, we would not expect a price hike or a price spike in the US propylene price in the spring.
Second question for Rob also. On the forecast, will US producers be competitive in Asia at the high prices you're forecasting?
Yes, we fundamentally believe that the US, specifically for polyethylene, has to be the cheapest source of export material. And even with the tariffs still in place in China, we need to export increasing amounts. The plants that Kristen showed coming online, Exxon and Shell, that's either going to displace domestic contract business, which will force somebody else to export. But the bottom line is there's no way the US can run their polyethylene units at 85, 90% operating rates and not export hundreds of thousands of tons a month. So yes, we need to price to export and discount to keep the ARB open.
All right, thanks very much, Rob. And thanks again to all of our panelists and to the APLA organizers for inviting us to participate in this event. You can see our email addresses on the screen in front of you. I'm sorry we didn't get to answer more questions today, but if you do have any questions, feel free to email the editors and participants. You can also use the APLA software to request meetings through APLA's site. So again, thank you. It was a pleasure, and hope you enjoy the rest of the conference.
Thank you.